got no muscle, no hustle, no backbone. I stand alone, not tripping, just saying I'm different. Ain't hanging
Well, good afternoon, listeners. This is Mr. Not Advice. I have my very special guest and co-host, Mr. Greg Reyes, here today, and we're going to do our final 2026 podcast of the year, and it's going to be a banger. Greg's done quite a bit of analysis and research on the topics that we're talking about today, and I'm really looking forward to hear what what thoughts he has about not only the AI sector and the so-called bubble, but also EOS, NVX, and maybe a new idea. How are you doing today, Greg?
I'm doing fabulous. How about yourself?
Well, I'm sitting here. Was it 2 weeks before Thanksgiving? It was 72-degree weather, so that's a great day when I don't have snow in Colorado. So, how about you up there?
About the same. It's almost been tropical. We're in the balmy 50s, and life is good.
So that's in fact, let me give the listeners a reference point. Greg and I did a podcast last Christmas, and we did a naughty and nice list, and I think we did pretty good as Santa Claus. We got EOS on the nice list, and NFX and BBBY on the naughty list. And let me just put this out there: when Greg and I talk about nice and naughty lists and what we think is going to happen with a company, there's no personal drive or desire to see a company fail. It has everything to do with speaking from the position of shareholders, from the position of traders, and then trying to look at the information flow and the data flow that's coming out of the company, as well as the perception of that company and what we think over the next 6 to 9 to 12 months could happen with the stock. But as always, everything we say is our opinion. It's education purposes and entertainment purposes only. And with that, Mr. Reyes, I am very curious. So we've had a lot of news about this AI bubble. I've been monitoring Oracle. Their credit deferred swaps are going through the roof. If their stock continues to drop, I think if they get down to 200, their debt to equity ratio is going to skyrocket from about, right now it's 520%. I think it'll go over 600%. But I don't think there's contagion there, but I think it's representative, hopefully, of some of the things that you're going to talk about within that sector and within the whole theme of AI, because it covers so many different topics. So with that, I'm going to hand it off to you, and I'll pop in with some questions too.
Thank you. This is a topic near and dear to my heart, and I suspect that I'm one of the few people that actually operated a successful company into, through, and out of the whole dot-com bubble. And if I look at what's happening here, there is not an analog between this AI build out and the dot-com bubble, in my opinion. And let me tell you why. So if you go back in the time machine and you look at, what transpired during the dot-com bubble, we had the web browser be introduced in the late 90s. We saw companies move rapidly to try to stand up websites. We saw the emergence of Google as a search engine. We saw the emergence of Amazon as an e-commerce company. We saw a number of dot-com companies stood up that probably never should have been funded, let alone gone public, like pets.com. A lot of these valuations had nothing to do with the underlying business model. And Mary Meeker, who is one of these rock star analysts back in the day, rolled out a new model for valuing companies based on clicks and eyeballs. And companies were valued based on how many users visited the site. And her thesis was, well, they'll just figure it out and figure out the business model. And we had a number of one-time events that resulted in massive spends that went away. We had Y2K. Companies upgraded their infrastructure, believing that when the clock struck midnight, all of these computer systems would tilt. We had euro conversion. We had telco deregulation. When the dust settled, what we found was that probably, 50%, 75% of these .com companies went out of business. We saw a massive sucking sound in terms of revenue when Y2K, euro conversion, and telco deregulation played out. And, what we were left with was Amazon, Yahoo, Google, and a number of companies that had viable businesses. And we've seen, this ascension over the last 20 plus years where we've had some real massive companies emerge. You can put Netflix into that mix as well. So if I compare and contrast that with what's going on today, what we're seeing is a new technology that, to the extent that it is effectively deployed, will help companies make money and help companies save money. So how will AI do that? Well, the hyperscalers will be offering services, whether it's Chat GPT, slash OpenAI, slash Grok, where you'll pay these subscription services and you'll be able to ask questions and hopefully be able to get insights and information very rapidly. And people will pay for that. And we may even see models where, depending upon the value of the data, you may pay more for that versus less. And then I think we're going to see a massive deployment that hasn't even really started yet in the enterprise, where enterprise companies are going to deploy AI infrastructure in the data center that's going to allow them to run an inference engine that will help them more effectively understand their business, run their business more profitably, delight their customers more effectively, understand which customers are more profitable than others, focus on them, weed out those that are weak. And it's also going to eliminate a number of jobs that are going to help companies be more effective. And if I look at this build out, everybody's focused on the hyperscalers, but that's really just scratching the surface. Are seeing the enterprises start to lean in? They're just getting started in their deployments. I'm even hearing about massive sovereign data center buildouts, where people think of this AI race as being between the US and China. Well, the AI race, in my opinion, is an existential crisis for a number of sovereign nations where they're going to have to deploy this infrastructure to compete at the government level and at the enterprise level. So, yeah, you can say it looks like a bubble, but to the extent that it is a bubble, I think we're in the very, 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 very early stages of it. And I don't think it's going to bust to the extent that it does bust in a way that resembles what happened with .com, because you don't have big percentage, maybe 30-40% be associated with these one-time events, Y2K, euro conversion, telco deregulation, and you don't have a number of companies that are buying this infrastructure that are not viable because they're, trying to sell pet products over the internet. I mean, Chewy has perfected that. So if you then look at what's going on with Oracle, yeah, I mean, it caught a lot of people's attention in terms of the way that their credit is blowing out. But what it says to me is that Oracle is leaning in hard because they want to be a leader and emerge in this space. And the market's going to sort that out as it relates to Oracle, but it's not a contagion by any stretch of the imagination. And one could argue that, this AI arms race is going to reward the people that spend early and spend large. So I don't really see the similarities, but I'm hearing about trillions of dollars of spend that go well beyond, what we're hearing about with OpenAI. So I think we're in really the top of the first inning, and I think that the implications of it are massive. And I'm going to talk about a new name that I've identified that fits into the ecosystem of AI infrastructure build out. So if you think about AI infrastructure, people think, oh, NVIDIA, it's all about NVIDIA. Well, NVIDIA is a critically important cornerstone of this build out with their GPUs that enable other pieces of technology to come into play, whether it's software, inference engines, whether it is back-end data virtualization software from companies like Vast Data that make it possible for inference engines to query an API that then goes out and looks at every piece of data throughout the enterprise, even down to the record level. Or data center cooling, which is an incredibly important $16 billion market that's going to explode because these GPUs run so much hotter than traditional microprocessors and are going to run even hotter as next generation GPUs come to market. And they're going to require new technologies that go beyond forced air or one-phase cooling. So I think that there's a massive opportunity, and we're going to see companies emerge on the scene that are going to play important roles in this ecosystem as companies move into the AI paradigm. So I'm really excited, and I think that EOS Energy is emerging as an incredibly important technology to help feed AI data centers with their most important external resource, which is energy, because they take as much as 9 times the amount of energy to run an AI data center as opposed to a traditional cloud data center. So I think we're in the early stages. I'm more excited about this than I was about the dot-com phenomenon. And not only do I think we have legs to this, I think that we're going to see new products, services, capabilities that will help companies sell more effectively, sell more efficiently, be able to cut costs, understand their customers better, be able to optimize their businesses. And yeah, unfortunately, there's going to be a number of cohorts that may see their jobs go away. Elon Musk tweeted an Optimus Prime video implying that robots are going to be able to do a level of surgery at such a reduced cost that anybody will be able to have world-class surgery. I think that certain aspects of the legal profession are going to be impacted. Certain aspects of the accounting profession are going to be impacted. It's going to impact jobs, but it's going to create new and exciting opportunities and create vast amounts of wealth, I think, for people that understand this for what it is. And if you're interested in investing, be able to participate. I think we're just at the beginning.
I've given this a lot of thought, especially since we talked about AI. And one of the major differences with, not only was, the WorldComs of the world, the level 3s with the transmission of data, the fiber itself, but also with companies like Cisco Systems and Newbridge Networks that were making the hardware. And the argument against AI is, well, yeah, but, it will become a commodity, just like routers and switches. And, I thought a lot about that. I don't know what you think of this, but with those products, with that technology, there was a ceiling. There was only so much data you could stuff through the line, and that's why at some point there was so much fiber out there that it did become a commodity and became priced like a commodity. And the same thing with networks and routers. They could only move data so fast through the physical cables and the networks that had been built. The difference to me between that scenario and where we are today with AI is what AI is going to do. I don't think anybody can truly measure any of the gains, productivity gains. Where are they going to be? What industries, like you were just saying? How fast do they scale those up? And the speed at which they scale them up, it's going to be, I think, is going to be breathtaking. I don't think this is a hardware issue. I'm glad you brought up NVIDIA. One of the guys, part of my team, is a former C-suite guy for NVIDIA. And he and I had a long conversation a couple months ago about, can China beat the U.S. in AI? And he said NVIDIA's, light years ahead of whatever the Chinese can produce. What the Chinese have is manpower, and they have lots of people that they're investing human capital and real capital into AI, but it's a specific segment of AI. So yes, it's a tool. NVIDIA builds the chip, the GPU, but what's going to be done with it? There was a limited topside for a Newbridge Networks making a new router. They were limited. It wasn't going to cause more creativity. It wasn't going to cause a loss of jobs. It was a piece of hardware, no different to me than if you plugged in a new computer or a new keyboard. AI is a totally different creature. And so, and speaking of Oracle, you know, obviously there are pretty smart investors out there and institutions that have funded this company to the tune of a 5x debt to equity. But that's, yes, is that large? I looked at the comparables. You got, the Palantirs, the NVIDIAs, all below about 30% debt to equity. But part of the reason I think there's such a concern is there is a tremendous amount of capital flowing into this, and we've yet to see, other than the hardware manufacturers, we've really yet to see any definable revenues in terms of what type of business model. And I think, as you say, we're in the first inning. I think the hard thing for me is going to be picking the winners and picking the losers. I always like to stick with the leaders, but I think this is one of those things, sort of like the industrial age that went through our country, that it's going to be very difficult to do that, and everyone's going to have to adapt. It's just it's going to touch every facet of our lives. So, what do you think, Greg, in terms of, when you look to identify good possible candidates or great candidates that are going to be part of catching this AI wave? What are some of the qualities that you look for?
That's a good question. And what I try to do is use that success filter lexicon that we've talked about in the past, right? So if I take AI and I decompose it, you've got obviously NVIDIA with GPUs, but there are a number of other private silicon companies that are trying to build, specialized silicon. Will they displace NVIDIA? I doubt it, but may they augment it? Possibly. So there are silicon privates. There are second-tier CSPs. There are database and AI modeling platforms, inference engines. There are storage aspects to this that I don't think are well understood. There's data center cooling as another part of the ecosystem. And of course, there's energy, which is where EOS comes into play. So if I think about it as an ecosystem and look at, the companies in the space, I try to put them through my success filter, right? Is there a big TAM? Well, obviously there's a big TAM. Is the technology novel? Do they have the right management team in place to scale? Do they have a path to market that will allow them to scale rapidly? Do they have the ability at scale to become highly profitable? So, EOS, as an example, when we first talked about it and I first got involved in it, I was thinking about it predominantly as a way to augment and optimize massive investments that had been made in wind and solar. It's kind of a no-brainer. You drop in the battery and you store energy during off-peak periods and discharge it during peak periods for less cost. Well, that has now evolved to a point where, in the case of EOS, they're starting to become recognized as an important technology that you can drop in long-duration storage batteries and co-locate them next to these large AI data centers and store energy during non-peak periods and discharge it during peak periods, with the primary benefit being they can reduce the cost of a data center from an energy standpoint by as much as 30%. And that's one of their highest operating costs. I'm also looking forward to talking about a new name in the data center cooling space. As these GPUs already run hot and they're going to run even hotter, you've got to come up with a new technology and architecture to effectively cool them, and cool them in a way that doesn't take up a massive amount of rack space, doesn't consume a massive amount of incremental energy, and allows the data center to basically scale and operate effectively. So I'm looking for companies in those spaces. And, there are only so many hours in a day. I'm pivoting and wading into the categories that we just discussed. And I think I've identified an interesting company that's not without risk that I'm involved with, but it could emerge as, one of the leaders in the cooling space.
That's interesting because when we did our call back in June, when everyone was losing their mind about EOS and we stood firm and we started buying, I think that was around $4.40. And here we are today, the recent action in EOS, not to pivot away from AI, but I do think some of the recent action in EOS, while incredibly volatile, I don't think it's been recognized yet as one of the premier solutions for battery backup, especially with, I just read one of our members had a technical analysis and their ability to go down to 5 milliseconds. I wasn't aware that typical battery backup is between the 20 and 30 milliseconds. And EOS is hitting on all cylinders from a technology standpoint. Their announcement of doing a rack system was very exciting to me, because that limits, then you're using less space within your facility. You can add and subtract as you need based on demand. It's just a beautiful model, and I think we're seeing starting to see the fruition or the fruits of the combination of Cerberus coming in with them helping financing. I think was it Frontier, and
Yep.
I think we'll see more of that too. It's really a great match. But before we pivot to EOS, what would you say in terms of beyond the company you're going to talk about today, the new idea, other than batteries, what do you think some interesting sectors that are directly or indirectly related to AI that you've been looking at?
Well, I mentioned cooling. There are a number of, when I say storage, I don't mean disk drives. I mean, a lot more disk drives are going to be consumed, but there's a company called Vast Data that is a private company that, rumor has it their last round was at $30 billion post money. And this is a startup that is going to exit the year doing well in excess of $1 billion. They just announced a massive deal with CoreWeave, but there's a whole software category that is just emerging, and these companies are private. And in fact, this data center cooling company that I'm going to talk about is private, but 50% of that company is owned, or just a little bit below 50%, is owned by a public company that is a publicly traded venture capital company that is trading at a massive discount to what this cooling company is rumored to have been valued at in their most recent round. So, I'm interested in AI software. I'm interested in storage. I'm interested in cooling. Obviously, I'm already very involved in energy. And so I'm, doing my pick and shovel work. And, when I have, something concrete in these other areas, I'm more than happy to share them. But, Vast Data, I think, is going to turn out to be an absolute monster in the space. Can we buy it today? No, it's private. When it comes out, will it come out at a monster valuation? Most likely. But the reality is, if companies are dependent upon their inference engine software and backend data virtualization capabilities, they're going to be huge. So I think what's going to happen is we're going to see leaders emerge in each of these AI segments, and we're going to see the technology evolve from, early days of data center, .com data center build out. It was RAID arrays, and it was network appliance, and it was rack servers, and it was data communications infrastructure from Cisco, and data center networking products from Brocade, my company. And then on top of that, value was added on top of those platforms. So I think we're in the early days. I'm trying to identify who I think is going to be a leader in each of those segments. And to the extent that I can participate, I will. And to the extent that I can, I'm going to keep watching until I can.
As before we segue into EOS, another gentleman that's part of our group, we were talking, and he's on the front line in terms of selling AI capacity, right? Compute capacity. And I asked him, I said, all this money going into it. He said, you don't understand. Companies don't have a choice because every company fears being left behind, even though the business model is not being completely fleshed out. They know that they must spend the money. And he said, this is, as you said, an arms race, but it's an arms race at the corporate level for the market, the end users, the corporate end users. They don't have a choice. Insurance companies, banks, they must spend. Large corporations, they have to spend because if they don't, they will be left behind. And more importantly, they won't own their own. I mean, I've seen more and more developments of these private large language models that, whether it's a institution or it's a corporation, where I think that's also going to be at the forefront too of specialized large language models being pushed out too, which all requires compute power. And so I found it very striking when he made the comment to me. He said, "Yeah, if you feel as though that the money being spent is sort of crazy, it is, but they literally do not have a choice. If they don't do it, they know they will absolutely be left behind and not be able to compete." With that, Mr. Reyes, would you like to pivot into our one of our companies that we are fans of that has had some pretty exciting developments and quite a bit of volatility over the past 60 days. So, why don't you give us some thoughts on EOS?
Sure. Be happy to. So as I mentioned, I've listened to the call multiple times, and each time I listen to it, I find new inferences that I didn't pick up on the first time I listened. So if you just look at the call, the the press release and the initial read of it was, oh shit, they had a revenue miss when they only did $30 million. And I got a massive position in the stock, and I, went to bed, didn't sleep as well as I would have liked to because I was thinking, wow, like, how do they explain that, and how are they going to maintain their guidance? Because they'd have to do 3x the revenue in Q4 that they did in Q3, and that earnings call was a tour de force. It was something to behold. They came out, and in the CEO's opening comments, they said that they had pulled in $43 million in customer deposits. They talked about their new factory, which was going to give them up to 8 gigawatts of capacity, approximately $4 billion in production capacity. They announced, of course, the second line. They haven't announced the timing on lines 2 and 3. They announced that after September that they had received a 1 gigawatt order, and the CEO talked about this being the early days of a super cycle. And I think that what is implied by that is energy demands are growing significantly after having been basically flat for the past 10 years. And that in order to effectively meet the increasing energy needs that have accelerated in large part because of data centers that are building out, that companies needing this energy are going to view long duration storage as a technology that will help them not only be able to gain access to low cost energy, but also be able to scale. So the point that you made earlier about, the EOS battery being stackable, bottom line is they said that they can have up to a gigawatt of EOS stacked batteries in an acre. Competitively, the next best in class competitor can only have 250 megawatts. So they can have 4 times the density in the same physical footprint. They talked about the fact that customers are seeing the value of an unlimited number of charge discharge cycles within a 24-hour period, where lithium ion is only warranted for 1 charge discharge cycle. They have, I thought, a 20-year life. The CEO talked about a 25-year life. Well, I'm aware of data where lithium ion batteries in the field are only getting between 5 to 6 years life in actual use. and they don't catch on fire, and they can operate at extreme temperature range in terms of hot and cold, and they don't require the fire suppression, cooling, heating that lithium ion does, resulting in a much lower total cost of ownership for the customer. And it's American made with 90% of the materials being sourced in the United States. And their customers benefit from the tax credits and the big, beautiful bill. So, if you go back to when we first started talking about this company, there was a lot of the data center thing was not well understood. And there were lots of concerns about Chinese batteries and the cost of Chinese batteries, and concerns about the big, beautiful bill basically gutting all of the subsidies for what was viewed as green energy. And it didn't work out that way. I mean, I think you can make a case that EOS is in almost a unique position as the only long duration storage battery play in the United States today. Now, people will say, well, what about Tesla? What about Fluence? Well, Tesla only has a 4-hour lithium ion battery. There's a market for that, but it's a different segment than the one that EOS participates in. And then people talk about Fluence. Well, they assemble batteries in the US based on Chinese technology. So, the net, and one of the other things that the EOS CEO said that it's one of these things where you kind of knew it, but you didn't really know it at a visceral level until he said it. He said, traditional power generation is installed for peaks. So what does that mean? It means when they build out power infrastructure, it has the ability to handle a peak that may happen 1 or 2 times a year. And that a lot of that infrastructure is basically sitting idle during non-peak periods during the day, and that just a 5% increase in utilization could power 500 million homes per year. So if you think about just being able to drop in a battery either behind the meter or in front of the meter, the economics are beyond compelling. And it's really funny. I hate to always bring things back to my personal experience, but at Brocade we sold a fiber channel switch that cost $1,000 support, and it replaced what was called a SCSI cable at $69 support. And people said, "Oh, you're never going to make it. Nobody's ever going to buy that. It's way too expensive." Well, guess what? You were limited to 16 connections on a SCSI port. And with our switch infrastructure, you had an infinite number of connections. And customers that bought storage would have 80% of it sitting there unutilized because they ran out of connections, and customers were happy to drop in a 20, 30, 40, $50,000 switch that would make all of that unutilized capacity available. And oh, by the way, they could connect an unlimited number of servers, they could replicate their data, they could back it up easily. That is a I haven't coined a term for it, but it's a physics changing phenomenon that by dropping in a switch, it paid for itself the minute that you hooked it up. I think the same is true for EOS. And I think that is just starting to become understood. If you go back to the call, Nathan Coker, the chief commercial officer, talked about having signed a number of MOUs with large AI data center / hyperscaler customers that they didn't want to announce until they turned to a hard order. But if you think about it, the implication is that they're already seeing that phenomenon in the customer base. So pivoting back to my angst after reading the press release, I was concerned about how the heck are they going to triple production? They talked about doubling production quarter over quarter. And oh my God, the margins look horrific. Well, then they rolled out John, I don't know if I'm pronouncing his name properly, John Mays, who's ex-G-Bill, guy's a legend in the contract manufacturing industry. And he basically said, we are now at a point where we have produced in 6 days what took us a month to do last quarter. And that they shipped 179% more cubes in the first month of this quarter than they did in the entire prior quarter.
Mm.
And Nathan Coker came out, and I was concerned about this, looking at the margins, and said, we're going to be gross margin positive in Q1 and profitable from a gross margin contribution standpoint, in Q1, and gross margin positive in Q4. So you look at that and you say, this is a company that is not only about to scale, these guys are pros, they know what they're doing, and they are standing strong and basically like Babe Ruth pointing to center field bleachers saying, we're confident that we're going to do 90 plus million in Q4 and we're going to be profitable. And then John Mays went through a whole full-throated explanation in terms of how they're going to optimize costs, take costs out, optimize production, reduce absorption. I mean, it was really a tour de force. So, I look at this as a company, and again, you know this about me. I look at things from a long-term standpoint, and yeah, the volatility can give you whiplash, and it obviously trades on a combination of technicals, and it seems to pivot to fundamentals, and then who knows what happened this past week. Was it related to the warrant expiration that's happening on Monday, and are people trying to lock in profits by shorting the stock for warrants? I don't know. At least for me, I don't really care. I'm more focused on what could this company be in 12 months. And if in 12 months they have 4 lines committed and 2 up and running at nameplate capacity exiting the year, this is a company that's going to be doing well north of $500 million next year, on its way to doing $1.5 billion to $2 billion in 2027. How do I know this? I don't. I'm just looking at the tea leaves and trying to connect the dots. But I'm incredibly excited about this company, and with each turn of the crank, it just seems to be getting better and better.
I spent my career sitting on the other side of the podium, listening to CEOs such as yourself and CTOs, and my takeaway from the call was they did an excellent job pivoting away from the importance of meeting their 2025 revenue guidance. I'm of the opinion that they could come in light. I also don't think it'll matter 3 to 4 months from now into 2026. Mr. Haas coming on and talking about that they can have a system up and running from production to delivery within 90 days. That was amazing to me. It opens up the door, I think, down the road for different types of financing. Looking at the stock over the last 3 weeks, as you mentioned, it's been very volatile. But the one thing I've been watching has been the volume itself and the size of some of the block orders coming through. Most of the times these institutions will try to use a dark pool, and those trades typically print towards the end of the day. And I've been watching this for the last 3 weeks, obviously much longer, but the change in tone of the type of buyer, again, this is experiential, Greg. I don't have proof, but what I'm seeing are institutional buying in whales coming into this. I mean, we've been averaging double average daily volume. And I think there was some preparation, or there was some front running, as always, especially when the governor of Pennsylvania is involved, and of course he's talking to his buddies and friends, and that starts to move it up. I'm not concerned if they come in light. If they make earnings 2025, I think that's great. But I think they did an excellent job in the meeting, as they should have, to remind people that this is not a 1-quarter company. This is a company that's probably, using the baseball analogy, I think they're probably in the second or third inning. And, I've, told our group that we are on the hockey stick now. We have made that transition. And now it's about, can they get enough equipment in place, enough lines to meet just meet their backlog of orders. That's not speaking to any of the newer orders that are coming. So, I believe and I've already mentioned to you, I think there's going to be a capital raise. I don't know what price. The warrants have that anti-dilution clause, and then that will be removed. So looking at EOS, you and I joked around at the beginning of the year, but we became much more firm about it. It absolutely has done nothing in the last 6 months that have diminished what I believe its potential to be a true unicorn stock. And when I speak unicorn, it's not just only the stock price. It's about building such a large moat that any competitor, as you had mentioned, there's one out there that 2-3 years they can come to market. Well, by that time, and there's things going on that just serendipitously with the China tariffs, with Buy American, with Trump in the office. But I don't think people appreciate. I think people can get caught up in the day-to-day volatility of the stock and not understand the structural foundation that EOS has put into play. There's no concern. I mean, they've got Cerberus, right? I was very excited to hear that they meet with Cerberus management once a week. I think that's fantastic. Obviously, Cerberus is assisting because they're doing the financing for Frontier. So that helps mitigate some risk for those customers that can qualify for that type of financing. And then, of course, as you said, in terms of what's in the future, let's say 3 to 6 months, looking forward for them, other than something that's a complete black swan event, and I don't even like to think of those. EOS just has to execute. It's no longer a story. A year ago, Greg, remember when everyone's losing their mind about the DOE loan, and you came and said, you thought the DOE loan was fine, and it turned out, again, you were right, and it was fine. I think investors can lose their mind over this volatility of the stock price. This is, yes, it's exciting to have a stock go from 4 to 1980 or whatever it hit. Personally, I was pissed off, Greg, because I called 20 that day and I was very upset. We missed it by 13 cents. 14 cents. But anyway, but I look at this company, it still remains, even, I've added back and I'm back up to 30% of my total. And I'm out to 2027 because I think maybe you coined this phrase as it relates to EOS. 2026 is going to be, in my opinion, a massive inflection year. I think this is the year where, if things go well, where it's not just a name that's known amongst a small, dedicated community of investors and those that believe in AI. I think it's going to become more of a de facto solution for not only hyperscalers, but also for the power companies that provide them that energy. And it's just amazing to me. I got to tell you, Greg, I feel very blessed to be involved in it for the money we have made in it. But I don't think we've seen anything yet, quite frankly, with EOS.
I couldn't agree with you more. It's kind of like, I hope I don't offend anybody with this analogy. Like you marry the high school prom queen and she's beautiful, but as time goes by, she just keeps getting more and more beautiful. And you find out that she's got all of these other things that you didn't really realize. What a great person, what a great family. It's like every time I come back to this name, there's not a single thing that is a decrement to the bull thesis. Just keeps getting better and better.
I was going to say, as one last statement on EOS, let's look back, since you and I have been doing podcasts for almost 2 years. Every single time investors got afraid, we were not. You had done your analysis. I was looking at the stock movement. And I think it speaks volumes to the combination of the analysis that we do on these podcasts, because they do come from very different points of view. And it's extraordinary to me that there are still people that I'm watching that are commenting on FinTwit about EOS, like those jokers, whatever, Panda, and those 2 young men last year. I don't get it. It mystifies me how you could possibly think that this is a company that's doing any of the accusations, and I just sort of have to laugh at that. But I watched this volume of the last 3 weeks, Greg, and from my opinion, there were some very, very large participants making sure that they got in at that moment. There was a specific time period to it that we saw that rush of volume. It wasn't like their earnings call was, hitting it out of the park on that scale of 1 to 5. I gave it about in terms of delivery, about a 3. Okay. But in terms of what they spoke about that's coming very quickly, it was a 5 plus. It was easily a 5 plus. So, for the people that are listening, always understand, Mr. Reyes said it. He's a long-term investor. Even I, with my leaps, I'm a longer-term investor. I just trade around the position. Yeah, why don't we move on? Which company do we want to go after next? Do we want to be in a
Let,
good mood or not a good
yeah,
mood?
let's be in a good mood. Let's talk about a new name.
All right, what do you got?
I have been thinking about the ecosystem of players in the AI space, and cooling is an important segment. And a friend of mine said, "Hey, have you heard of this company called Excelsius?" I said, "I haven't." And I did some research, and I said, "You can't buy this thing. It's private." He goes, "No, you can. 50% of it, approximately, a little less, I think now, is owned by a company called InVenture. InVenture is a publicly traded venture company that's come out into the market using a new model. Like the traditional venture model was 2% fees to the venture capital company and 20% of the profits. And unless you were an institution or a very wealthy individual, you'd never have a chance to invest in Andreessen Horowitz's next fund or Sequoia's next fund. Well, these guys used a SPAC model to go public. Obviously, they don't have the 2 and 20 fees and publicly trade based on their investment portfolio. But what a lot of people don't know is this is the same venture capital team that funded and managed PureCycle.
Hmm.
And the company is called Excelsius. They're in the data center cooling space. And as I mentioned, they're private. And if you study the data center cooling space, back in my day, when you walk into a data center, it sounded like it was a jet engine because you had all of this cold air blowing across the CPUs. Well, then the technology evolved to something called single phase cooling, which was a mechanism to basically run cooled fluid across these chips to cool them. But as the chip processing powers increase, the heat has also increased geometrically. And what Excelsius has are two technologies. One is called two-phase cooling. And what two-phase cooling basically does is you put what's called a cold plate that sits on top of the chip, and it's cooled by a refrigerant that is not electrically conductive. So if it leaks, it won't short everything out like the one-phase water-based technology does. It frees up 75% of the rack space,
Wow.
which is a big deal because footprint matters. So you have a cooling technology that frees up 75% of the rack space. It cools with 50% more efficiency, and it uses approximately 50% less energy. So they're based in Austin, Texas. They're a bunch of ex-Dell guys that have a lot of experience in data center build out. They announced a strategic investment of a small amount from Johnson Controls that I suspect has a lot of legs to it. They haven't said anything publicly, but if again, part of being successful in predicting the future is connecting the dots. I would not be surprised if Johnson Controls would end up being an OEM for Excelsius technology. On the most recent INV call, they talked about, not in a lot of detail, but in enough detail to get your mind around it, that they've had a number of significant proof of concepts that are now turning into orders, and they're about to start scaling manufacturing. And I don't know what the Johnson Control round was done at, but rumor is that it's north of uh, getting close to between a half a billion to $1 billion. There's rumors of another big strategic round with partners that will take their technology to market, and we're talking about hundreds of millions of dollars per quarter in relatively short order if they execute. So back to INV. INV's trading at about a $200 million market cap. So if they own approximately 50% of Excelsius, and Excelsius was post money valued at, I'm making this up, $1 billion, that would mean that INV in theory, if they got 100% credit for that, which they won't, would basically be, as much as 5x where it's trading today, which is $3. And it's also safe to say, if you compare it to Vertiv, which is the gorilla in the space, which does not have two-phase cooling, they got a $62 billion market cap. Vertiv does. So if they emerge, and this is a high risk speculative investment, they're just starting to scale. They say in 2026, this company could emerge as a company that gets bought or a company that goes public. Now, the other thing that really excites me about this company is they have a technology called chip to die, and their existing technology, which uses a cold plate and is two-phase, sits on top of the chips. Well, what chip to die is there's a lot of discussion that in next generation GPUs, you're going to have to basically etch into the silicon channels where you can run coolant, non-electrically conductive coolant, directly on the chip. And they have that technology. They've got it, and they're basically in a beyond proof of concept. I mean, as you can imagine, the engineers are all thermal engineering experts that would give them legs beyond two-phase cooling, which is just starting out. So I really like this company. I like the management team. I like the fact that the founding team is the ex-venture team that found the technology and put the team together for PureCycle, which we'll talk about next. And it's a way to play in the space. I mean, do I want to own Vertiv at a $62 billion market cap, knowing that they don't have state-of-the-art two-phase cooling or chip to die? I don't. It's 62 billion. I would have loved to have been able to have owned the stock at $1 billion. And that's how I'm thinking about this company, Excelsius. And the way to own it at a discount today is by being involved in Inventure. And the other positive about Inventure is they have a portfolio of some other companies that there's value associated with it. So that's a way to play in this quartile of new and emerging AI companies that aren't yet public. So that's a new idea. I like it. But again, for me, I've got, a higher risk profile than most folks. And I'm certainly not giving it any financial advice, but I think it's an exciting opportunity for people to put their toe in the water in the next phase of the AI investment ecosystem as it starts to evolve.
Well, I have to make a confession to you because when we talked about the podcast and you were mentioning companies and everything, did a little bit of digging. Obviously, nowhere near the level because I have you as my expert brain, and so they offered options on Friday, and so I went in and already bought options on it. I intend to continue to buying more of it because I haven't reached my threshold in terms of risk. And it's surprising to me. You typically don't see $3 companies all of a sudden offer options contracts.
Uh-huh.
It doesn't happen. And
Uh-huh.
in the past, and I'm not predicting anything, listeners, but I'm saying to you is from my experience of 30 years in investment banking, you don't do that unless you're preparing the stock to mature to the next stage. As you always say, Greg, re-rating a company. Well, this is similar to re-rating the stock. They are prepping it for. That's my opinion. I think that's something you do if you're prepping the stock itself to be taken to the next level, and the next level is broader retail exposure, but also more importantly, institutional exposure. Institutional owners of that stock need a way to hedge, and the best and easiest way to do that, obviously, is through option contracts. So I have to confess, on Friday, the minute they started trading, you could go look at the timestamps. All of a sudden, a bunch of trades went through because, that was something to me beyond the technology part, which I don't fully understand. But for me, from the stock side, I looked at that and I said, well, that's not something you see. You don't see that. You don't see stocks trading for $3 come out and start trading option contracts. Costs money to do that. So that was very intriguing to me, and full disclosure to the listeners that, myself and some of my team members, we do own some of the calls, but we've just started buying those. This is something to me, based upon, Greg, your analysis, based upon your deep dive into it, and that it meets your success filters. And then, I did ask a couple people that are in the tech sector about this type of, they call it evaporative cooling, but two-stage evaporative cooling. And their response was, well, yeah, if they can do it, because they've seen others try. It's extraordinary, the ability, and I got to give you some accolades here. I don't know how many frogs you kiss on a weekly basis, but some of the companies that you're coming up with that we talk about are just fantastic potential. And I echo Greg. I mean, this is a higher risk, almost it's not pre-revenue because they're generating some revenue, but it's a higher risk. And here's my question for you, Greg. Okay, so let's assume that there's going to be an increase. Let's say it's not a stratospheric increase in demand, but how are they going to pay for that? And I know they did that small offering, but with the options in place, I don't know. It leads me to believe that they're setting the table, maybe not next week, next month, but within the next 6 to 9 months, they're setting the table to try to get this stock at a more mature level in terms of a structural maturity, with the addition of options and with and I also saw a fairly large 2x the volume over the last 2 weeks on some days too. So it's not just this stock sitting there doing 400, 500,000 shares now. Then on top of that, you get these options starting to trade, and you're talking about a stock that now has matured to the next level. I'm excited about it. I don't fully understand the technology, but my gosh, if they're able to bring this to market at scale, unbelievable numbers we're talking about. Isn't that correct?
Oh, I mean, it could be as much as $100 million a week, but again, that's kind of pie in the sky. But to answer your question, it's a little bit complicated and nuanced in the sense that Excelsius is a private company. They can raise money through a placement. They can raise money through strategic investments like Johnson Controls, which I want to talk about in a second. And Inventure is its own separate entity that just happens to own approximately 50% of Excelsius. So I don't see Inventure needing to raise money to fund Excelsius. Excelsius can fund Excelsius. What I see is an arbitrage opportunity between Inventure, which is inexpensive in relationship to an asset they own that could be worth 10, 20, 30 times ultimately what Inventure's value is today if Excelsius is successful in making this metamorphosis from a startup to a company that's generating revenue and scaling. And it feels like 2026 is the year for that. As far as the tech is concerned, I really encourage people to go to YouTube and look at some of the videos there from Excelsius engineers. I mean, it is very, very impressive. But what is more impressive to me is that Johnson Controls is a serious company. And they didn't just make a small equity investment, they had a slide in their earnings call, I think it was 2 weeks ago, about Excelsius. And they didn't say, but they almost said that they were going to be taking this product to market and reselling it to their customers. Because if you look at Johnson Controls' portfolio, they've got cooling in virtually every area other than directly inside the data center, and Excelsius would give that capability to them. And we've all got our technical experts that we rely upon. I've had some of them look at the Excelsius technology. There's a white paper out there. I'll post it tomorrow, saying, "Man, this is really impressive." Again, if it works and they can build it well. I believe that they're going to have a predominantly an OEM model to scale manufacturing, which I like. I like it a lot because it doesn't require the amount of capital that it would take if they were going to do it internally. And it's an OEM distribution model, which allows them to scale rapidly. They don't have to build out a large end user sales force. And I'll mention this to you. I'm kind of excited about it. You may have seen the tweet that I put out about a spaces that I'm going to do tomorrow at the close of the market. Well, I've contacted Inventure and I'm going to host a spaces, and one of the members of the Inventure management team is going to come on, and I'm going to, basically walk through kind of an interview with an interviewing model and ask him questions, and it'll give him an opportunity to talk about not just Inventure, but Excelsius and the rest of their portfolio. So I'm pretty excited about it. And what's interesting is Inventure had their earnings call the other day, and I think there were maybe 3 people on it. So it's just not well known. And I think to the extent that it is well known for people that have an appetite for risk and want to be able to participate in the evolution of companies in the broader AI ecosystem. I happen to think they're best in class, and it could be a 10-20 bagger, it could be a 0. I don't know, but again, I have a different risk profile. I'm the guy who bought a couple million shares of EOS notionally with long-term leaps when the stock was below $1. Because I was just hoping, looking at the timing of DOE loans, I thought, man, this loan should be hitting pretty soon based on prior loans. And then Cerberus showed up, and it's like, wow, I get it. I got it instantly. And now here we are, stock's gone from $1 to it's in the mid-teens. And I think it could be going to significantly higher numbers in the future. So I'm excited about Excelsius. I think it's interesting. And it fits into the AI data center lexicon that I'm excited about for the reasons that we talked about at the beginning of the podcast.
With INV, it would be beautiful if they did a institutional private transaction that was already placed that wasn't immediately dilutive. And for those of you that may not understand how a private company is going to increase the value of INV, well, it's as Greg was saying, as if they do an offering, they're going to have a re-rate on their market cap, and whatever that re-rate is will affect the price. This is how the math would work if it does happen. Additionally, for your spaces call, I did see that. I was super excited. And listeners, if you want to go to that call, I'm selling tickets for $250 for that call. But hey, let me ask you this. So are they really good at doing samples too? Like one of the companies we were going to talk about in a little bit, or they're beyond the sample stage, right?
No, I think they've got real deployments with real customers that actually the difference is somebody that takes a sample isn't a customer. They're not a customer until they actually place a purchase order. They've actually got customers placing purchase orders.
Wow. I didn't think that existed in the tech space anymore. I thought companies were just primarily send samples on, just hope and pray. But
yeah, very excited.
Which so listeners, that's tomorrow. Mr. Reyes is going to be posting on X a Spaces, and I'll be listening in if he'll let me in the room. And I know a bunch of my team members want to hear about it. I do know one of the team members on the one of the people listening to INV call was one of our guys that he wanted to hear about it too. He had come through it from a different angle, so very exciting. But that's at the market close Monday tomorrow. I would really encourage you, even if you're just curious. I mean, you're not going to get. And let me say this. So back in the day, before there was technology, analysts carried a tremendous amount of power. And because you didn't have a Bloomberg, you didn't have the web, if I wanted information, I had to hope and pray that Standard & Poor's had done a 2 or 3 page report on a company. And so when I hear Greg talk, it reminds me of when in my first decade in the business, where analysts actually added alpha, where they actually stated their opinion. And their whole goal wasn't just to not get fired on a quarterly basis, right? They didn't want to be the nail that stands up. That's what analysts do now is they all group together because they don't want to be the guy that says, if every other analyst is saying, well, I think it's gonna be a 30 and they come out and say at 40, well, if it's not, they're gonna have a problem. But if they're saying 30 and everyone else is around them is saying 30, 31 other analysts, If it doesn't get there, they can always point that, well, it wasn't their fault. And so I really appreciate, and I hope our listeners appreciate that the ideas that we talk about, and this is not, listeners, this is not an arrogance, this is a statement of fact. Greg has steered away ENVX. He has steered away from Bed Bath and Beyond. He steered towards EOSE. I don't know, and that's just in the past 12 months. And so the level of analysis that Greg puts in, I personally know. I would encourage you, even if you know nothing about this technology, you've never heard of it, it is going to enlighten you, if for any other reason, the process that he goes through and also the questions that he asks management. And so I would highly encourage it. I'm going to be there. I'm excited about that. And shall we go on to our last company that we're going to speak positively about?
Yeah, so this is a bookend to INV that I like a lot, but I have a lot of questions. I do own a large position. When I say a large position, that's north of 7 figures, common/notional, is Pure Cycle. I love this company. I love the CEO. I mean, Dustin Olson has 20 years of experience in the polymer business. The guy is a top tier operator. And this is a company that I like a lot. I just can't figure out yet what the inflection point is. So let me just give you the highlights in terms of how I see it coming on the conference call. So they announced they were going to stand up a factory in Thailand. They also announced that an individual named Dr. Suri joined their board. He's the chairman of a company called IRPC. He's a director at the Bangkok Bank, and that he played a key role in lining up debt financing for this factory, or that's in process. Their Ironton facility has a maximum capacity of around 100 million pounds. They're going from 2 shifts to 3 shifts. The polypropylene that they manufacture, the virgin polypropylene from recycled plastic, sells for around $1.20 to $1.50. So that says that factory at 100% capacity will only be able to generate about $100 million plus, 125 to 150 million, which leads you to the next question, which is, when are the other factories being stood up? And they were not as clear as I might have hoped. And they talked about, the 2027, 2030 timeframe, which, for me at least, it's like, well, when do I really lean into this thing? Well, I really want to lean into it when they're about to hit the revenue hockey stick. It's not clear when that's going to happen, but I suspect that it's going to start happening in 2026, because the CEO said that they've got product that is going to be manifesting itself through products that Procter & Gamble sells that are going to hit the shelf early in 2026, that they've got 4 or 5 projects that should be in total around 40 to 50 million pounds. So if they can do 100 million pounds, that could be 40 to 50% of their capacity out of their Ironton facility. And they've got 75 to 100 other projects that they're being qualified on, which implies that Ironton could be sold out many times over, which on one level, it's really exciting, but it's frustrating not knowing when, with precision, when these other factories are going to be stood up. They're making progress on Thailand, and they received an EU Innovation Fund grant for $40 million, which implies that the technology in the factory in Antwerp is going to happen, and that they're in the middle of the permitting process. It's not clear how it's going to be funded. And they also talked about the fact that in their Colorado facility, which is where they get their feedstock, that they're able to sell like 20% of it. And the implication is that they'll get incremental revenue for that, and that will in fact reduce the costs of their feedstock components. So what I love about this company is it checks so many of the boxes that I look for. This is a massive TAM. They've got truly unique, innovative technology that allows them to generate virgin polypropylene. They've got a ton of customer engagement. This thing should scale into a monster. I just don't know how to handicap the when, but I think that at least for me, I'm happy to hold it and own it. And when I get a good sense as to when this thing is going to really start to rip, that's when I would be interested in sizing up. So I love the company, love the technology, love the team. Just am frustrated that I don't understand what the specificity is around the other three factories, and I get it. They're probably working on financing and they're working on permitting, and I think that will reveal itself, and I want to be in position to participate in that.
I think one of the things for me anyway, as a trader looking at PCT, um, uh, it's sort of boring to me. Uh, the product, because I don't fully understand. I'm probably polypropylene and looking forward. Is this number wrong that it takes them 12 to 16 months after they stand up a factory to be able to be up and running? Is that an incorrect number, Greg?
I think that's probably, using Kentucky windage, I think that's pretty darn close, which says that, this thing probably is really not going to be scaling and ramping until, mid to the second half of 2027. But who knows what's going to happen if they sell out the Ironton line and they're, sold out many times over. It's certainly going to help them on the financing front. I just don't know how this one's going to play out, but I like the market. It's huge. I like the technology. It's novel. Recycling plastic is a huge problem for the globe. So it's not a virtue signaling company that has no viability. It solves a real problem. If you can buy virgin polypropylene at a small increment to made out of recycled plastic, I think the demand is massive. And the fact that they've got, they said they've got, let me just look at my notes. They said that they've got, 75 to 100 other engagements, all of which could do approximately 40 to 50 million pounds. That's pretty darn exciting.
Did they have in their initial relationship was Procter and Gamble itself, correct?
The INV venture team cut a licensing deal, as I understand it, with Procter and Gamble, and Procter and Gamble is a strategic partner, and Procter and Gamble is a customer, which is kind of interesting. If you go back to the early days, and I'm going to really date myself when I say this, back in Silicon Valley, Xerox had a research group called Xerox PARC. And they invented the touchscreen, and they invented the graphical user interface, and they invented the mouse. But for whatever reason, Xerox could not productize and commercialize it. It took companies like Logitech and Apple and others that basically licensed this technology or took it to market in an instantiation that didn't infringe on patents and made tens of billions of dollars of money for investors that Xerox could just never find a way to monetize. And it kind of makes sense. I mean, Procter and Gamble's in the consumer product business. They're not in the plastic packaging business.
Mm-hmm. Well, and we talked about this company before, and you really shared the strength of the management, especially the CEO, of willing to roll up his sleeves and sort of get dirty, right, and get the work done. And that's one of the things that when you speak highly of management, I really take a look. I have the same sort of frustration with the stock right now because you don't know when the inflection is going to happen. You don't know when any of those ideas are going to be converted toward actual purchase orders, but that's part of it. I mean, you came up with mid 26, and I'm about the same place, mid to end. That's barring them starting to hit a cadence, which we're starting to see from EOS, of just announcing deals regularly, new orders regularly. So I already have, I think I have a long position in Leaps in it, but I haven't built anything of size because I personally think, my opinion is, I'll have time to do that, especially if the overall market, if we don't get a cut in December, these small cap stocks that are, and especially tech stocks that are dependent upon funding. So they sort of get dragged down if we don't get an interest rate cut. And I'm I wouldn't be surprised to see the stock trade lower, but it's not in the same case of, well, ENVX, where I honestly believe between now and January, unless they were to pull something, out of the rear end, that's a surprising deal or something, the stock's going to drift down below $5. There is no reason to own it between now and January. There's literally no reason to own it between now and February until they come out and do another update. And I don't see any institutional support in ENVX right now.
Well, maybe now's a good time to pivot to another, because I'm not sure that there's a good reason to own it ever. And I'm kind of a pariah in the ENVX fan base because people keep saying, oh, new innovation and new technology is hard and you need to be patient. And it's kind of like, if the technology was so good, they'd have customers lined up around the block. It's not even selling virgin polypropylene from recycled plastic. They've got 75 to 100 customers that are in, piloting, and we've got, Honor as the only name that's been mentioned. But if I look at ENVX, and I've been there since the de-SPAC phase, and I'm almost embarrassed to have been involved in this company because I relied a lot on the patina of TJ Rogers and Raj and their experience. And, these guys are seasoned guys with track records. And I took what they said at face value. And maybe they believe what they said at the time that they said it. I have to assume that they did. But you look at where this company is today, and I'm not being critical. I mean, people use the term, oh, he's a bull or he's a bear. I'm not a bull or a bear on any of these. Just like, do I want to own it or do I not want to own it? I don't short stocks because I suck at it. But in any event, so they reported that they did $8 million in revenue. It was all from Routejade in Korea, which is in the legacy lithium-ion battery business. They bragged about how they had $648 million in cash. Well, $532 million of that is debt. That when it comes due, they're going to have to raise more cash to pay that down. And if this company's not scaling, it's going to be, ugly, in my opinion. But they got time. They announced Honor as a name that Raj referred to as a customer. Honor was not. They didn't have a quote in the press release, which I always find interesting. Like the CEO of Honor didn't come out, or the head of the smartphone group didn't come out and say, this is the best technology ever, and we're excited to bring it to market. Raj referred to him as a customer, but he said, quote unquote, they're entering the validation phase, which tells me that they shipped them samples of the AI-1, which is a renamed version of the EM2, that they stuck AI on it to get people as a name to get them excited about it, and that they have plans for their second smartphone customer to enter qualification, and that they're shipping samples to 9 partners. If you're just able to think critically, Honor is not a customer. They're testing again another spin of the battery to see if it's viable to take to market. There's no commitment to take it to market. And they got a second customer that is qualifying batteries. And Raja said in the past, unless he has found a new alchemy, that's a 9 to 12 month process. And they've shipped samples. Well, shipping samples is nothing. I mean, Olive and Coco just sent me a Christmas gift sampler of nuts and licorice. I'm not going to buy any, but I appreciate the freebie. And they talked about building a new factory in Korea. So I just look at this and say, and this is really important. In the past, there was discussion about them ramping in the second half of 2024. And then the second half of 2024 slipped to the first half of 2025. And then they were supposed to start ramping in the second half of 2025. Well, on the call, they now push it out to the second half of 2026. So this company is not even close to being able to scale. And as it relates to Honor, they said they're going to start integration in the first half of 2026 and scale production in the second half of 2026, and that design integration is underway, whatever that means. But there's no mention of volume. There's no mention of, hey, we're going to have our battery purchased to reside in this Honor phone, which ships, 1 million units a month. None of that. So, I don't know. I just think it's very, very sad. And the other thing that I do want to talk about is they had a slide where they talked about the TAM and the opportunity, and they broke it down in terms of smartphones, eyewear, defense, and EVs. Well, basically, we just talked about smartphones, that slipped from the second half of 2024 now to the second half of 2026. They talked about eyewear as having small potential. It's a small market, and it may just be the best market for ENVX in terms of battery density and a small form factor. They talked about defense and drones. Well, I hate to break the news to everybody. The ENVX battery is heavy because of the mechanical constraints and the way that it's manufactured. Actually, Empress has the best battery, in my opinion, in terms of energy density and feather-like weight to fit into drones. And I think that's why Empress has gone from, a buck and change to around $10. And then they talked about, EVs. Well, I remember back in the second half of 2024, Raj said they were providing EV samples, and now here we are talking about EVs being a future potential market. So, I don't know, man. I mean, it's just very, very frustrating because the initial story checked all of the boxes. Huge smartphone TAM, novel technology. Silicon was going to be the world beater as an alternative to lithium ion in terms of density and the ability to have as much as 30 to 50% more density in the same form factor. And it was just about scaling manufacturing in Malaysia. We don't even hear about Malaysia. They used to roll out Ajay, who was the COO, and he'd talk about, where they were in terms of zone 1 and zone 2, and everybody was focused on, FAT and SAT. Well, it's like Malaysia doesn't even exist. And I bet if you flew a drone over that Malaysian factory, the parking lot would be empty. So that's kind of how I think about Enovix.
Well, I remember 2 years ago when I first got introduced. Well, I did a first podcast on Innovix, and I said two things. I said all I have to do is name a customer and name an order, and here we are 2 years later, still waiting for that. In addition, when they bought Routejade, my comment was all they're doing is buying revenues. They don't have revenues of their own, so they're going to buy revenues, which is what they did. Then on the call, I heard they were looking at possible acquisitions. My response to that is, oh, great, you're going to buy more revenues. But at the end of the day, okay, if their technology, as you said, if the tech was so great, we wouldn't be here 2 years later, still waiting for an OEM customer and an order of size. Nor would we be continuing to hear how they're changing the battery chemistry. And I mean, it's constantly a moving target with them.
Excuse me for interrupting. The goalpost just got moved out a year.
Yeah, but to them, it's. I mean, they must be nearsighted because to them, it's always right around the corner. I mean, it's going to be the next one, the next one. I will say this: they've done an excellent job maintaining shareholder moderate confidence, and I think that's breaking down now. I think people are. It's been 2 years since I got involved. I got involved at the beginning of that year when the only reason I got involved was I saw TJ all of a sudden. I saw, he's buying $1 million worth a day. And that was it. It was a momentum play. And then I started reading into it. But, and I sort of hold a softer spot for Raj than most people do, just because when the guy got hired, he didn't get to set any of the goals. I mean, TJ effectively said, we're going to do this, and bringing on Malaysia is a great point because for all of 2024, that's all we heard about, right? Malaysia, and the prime minister of Malaysia is going to come and visit the factory. And it's in this huge technology park where there's other players in there of much bigger size. I haven't heard a thing about it. I don't know. It sounds like they're a company looking for a product because the product they have, Mark doesn't want. Because at the end of the day, if the market wanted it, they wouldn't be shipping samples. They'd have customers.
100%.
And so it's sad. You and I don't enjoy when people lose money in stocks. We just don't. But sometimes you've got to look beyond the hype. And this last call to me was, you could play that call. It would have been 90% the same as their previous 3 calls. It's the constant thing, right? We're shipping more samples, really interested. We're going to get an order, and we're in that final stage. Well, okay, how big of an order? How many units are we talking on an initial order? Oh, we can't talk about that. It's, I think they've pretty much burned the candle of goodwill with the investment community. And I think that the stock, unfortunately, between now and February is going to go below $5 unless they announce something. I think their next announcement is going to be some acquisition, Greg. And as you brought up, it's going to be paid for by future shareholders, right? So, God bless them. Why don't we end with? Well, we'll just make a slight comment about Bed Bath & Beyond, because I always like to talk about Marcus Lemonis, just because I think he's been excellent at destroying shareholder value. And this latest pivot to the franchise model, I just don't comprehend. And I don't comprehend. In fact, I put this out. I was talking to some of my members, and I said, look, if you're a shareholder, all you have to do is look at the last 18 months and look at how many times they've switched their business. It's extraordinary to me that any shareholder would still want to be involved with this company. I just do not understand it. Maybe you're more positive than I am, sir.
I don't know, man. I mean, just like I said with TJ Rogers, I was a fan of Marcus's television show. I like watching it, and he seemed like a stand-up guy, and he seemed like he was a serious bare knuckle operator. But it's pretty clear that they're building the airplane while they're flying it, and that airplane is losing altitude. The only thing that really jumped out at me, other than the franchise model, which the strategy du jour, every quarter there's a whole new strategy that's going to be fantastic, is in Q2 they had $135 million in cash.
Mhm.
And Marcus, talked about how, they got a strong balance sheet, they got $167 million in cash. Well, the reality is they diluted shareholders by raising $113 million in cash using the ATM. So if they had not raised that cash, they would basically be in a position where they had, 32 million in cash. So, the way I look at an ATM, I hate ATMs. I think they're any company that is using an ATM to fund operations is basically consuming muscle. It's not an athlete that's growing stronger. They're basically eating themselves alive, and it's strategy du jour. And I just learned that you got to look past the slogans of don't bet against Marcus Lemonis or TJ Rogers or whoever. I mean, that stuff doesn't mean shit. It's really about just trying to understand the business and the market. But if they sell a consumer product on the internet, and they have no unique value proposition. They've got a celebrity as the CEO who may have been better off sticking to being a pretend CEO on television, but they're just incinerating shareholder value. I mean, I don't have an axe to grind with him. I don't have an axe to grind with ENVX. It just kind of is what it is.
Right. Well, and I'm a little harder just on Lemonis, just merely because I look at, even with his Camping World, they were roll ups. Look, I wasn't a CEO, I was a COO, and it was only on a 2-year basis. So I nowhere have the experience of either Mr. Lemonis or definitely not you, Greg. But I do know that roll ups are perhaps some of the most lucrative businesses to do, because you're cutting costs, you're standardizing all your operations, and he hit it at the right time. COVID helped increase all the sales for automobiles as well as campers and all of that. And now that industry is getting smashed. Looking at Bed Bath and Beyond, I honestly don't know how they're going to generate revenues. That's my I go on Amazon and the quality keeps getting better. So how is Bed Bath & Beyond going to continue? How are they going to generate revenues? And who in the right mind would ever buy a franchise? that's my other thing. Like, who's going to do that? Maybe people will, but it's not, to me. Unfortunately, I look at ENVX and Bed Bath and Beyond, and I think they both have equal chances of being below $5 by the time the end of this year rolls around. They just simply, for different reasons, I guess for the same reason, but I would say, Bed Bath and Beyond, it's management. I think that the lead in maybe made Mr. Lemonis look a lot better, because I think there were things going on within our economy that helped his business model for Camping World. And then with Bed Bath & Beyond, I'm like, we're on our third iteration of what the business plan. I love your analogy, building a plane while they're on it. So, yeah, and I feel, I feel badly for the shareholders. I think shareholders should demand more, but shareholders are in a difficult spot. You listen to people that and I don't, I'm not saying that Mr. Lemonis doesn't have integrity. I'm just saying he hasn't executed to the level that he said he would. And that's hard, right? It's hard as a retail investor to hear somebody, especially, if they've been on TV and he says a lot of the right things. But man, you just look at the operational history over the last 2 years since I've been watching it, and you think, as an investor, there are many, many other better opportunities out there, many other opportunities. So, with that, I do want to remind listeners that Mr. Reyes has his Spaces call yesterday on INV, and I really encourage you to listen in to that. I will be listening into that, and this will be our final podcast of the year, and I'll round up Mr. Reyes to do something in January, so we can do some predictions, or at least he can listen to me make predictions. But I wanted to express to people how thankful I am that Greg takes the time to do the deep dive analysis, because all of us can sit there and maybe find this information, but to actually understand and go through it, and then put the pieces of that puzzle together to where you have a definable, or at least a directional thesis for the operations company is just, this is very special. So thank you so much for doing that, Greg, and coming on all the time. And please, any final words, and would you take us home?
Well, thank you so much for having me. Thank you for your kind words. And I wish you and your family and all of your listeners a healthy, happy holiday season. And I hope everybody goes into next year with the eye of the tiger and excitement, because I think 2026 is going to be another fun ride for all of us.
Well, between our teamwork here this year, we did pretty good. I'll say
I think
that.
we did. I think we did.
Pretty good. So thank you very much, everyone. Have a happy Thanksgiving and Merry Christmas, and we will be back in the new year.
All right, my friend. Take care.